Hi, everybody. Welcome to the Quarter 3 2023 market commentary. Hope everybody's having a great summer. Hard to believe we're already through the first half of this year. But we wanted to provide an update for everybody where we're at in the markets today, as well as what we foresee going into the rest of the year. We've had a lot of noise this year so far. We've had a banking crisis. We've had a threat toward U.S. default, continued interest rate increases by the Federal Reserve, ongoing recession fears, a lot of noise going on. But despite all that, we've seen one of the best first halves of the market in history, with the S&P being up about 16%. Today we're going to focus on what contributed to that first half, as well as what we see going forward. The first contributor to why we had such a great first half was the resiliency of the U.S. consumer. So we discussed this in last quarter's market commentary, was can companies outperform their earnings expectations? And we saw exactly that in quarter two earnings. In fact, 77% of companies outpaced earnings expectations. That's a tremendous number. Will this continue going into quarter three, as we're in earnings season now, as well as the rest of the year? That's to be seen. But one item that we thought was very interesting, a lot of you are Amazon Prime members. Amazon just had their Amazon Prime Day last week, July 12th and 13th. For the first 24 hours of Prime Day, Amazon actually had its best Prime Day ever in terms of sales. That's unbelievable. Now, is that a leading indicator? Potentially, but that might be an indicator of how strong the U.S. consumer is and will continue to be going into the rest of the year. The second key contributor that led to such great gains in the first half of this year was inflation. Really, inflation and the Federal Reserve. Okay, so what we saw in June actually was a decrease in inflation back to its lowest level since March of 2021, down to 3%. This allowed the Federal Reserve to really pause their interest rate hikes. A lot of the volatility in 2022 was caused by an aggressive Federal Reserve increasing interest rates. Well, then they paused in June because, they saw inflation tick down quite a bit. They still have a long way to go to get down to their target rate of 2%. And really, we see two more rate increases is what we're predicting for the rest of the year. They're actually meeting next week, July 25th, to discuss if they should do another 25 basis point rate hike. But we'll keep a sharp eye on everything. But right now, the market is predicting two more rate increases by the end of the year. One thing to keep in mind, though, as we look forward into the following year, is inflation doesn't necessarily mean market volatility. It's really only when inflation's at the extreme that it causes market volatility, such as last year when we saw inflation last summer at 8-9%. Equities and bonds were beat up quite a bit last year because of that. But take a look at this chart that we'll show here in a minute. Actually, even when inflation is 2, 3, 4, 5%, you actually see equities and bonds do quite well. It's only when inflation is at the extreme, above 6%, and for that matter, even in a deflationary environment, if inflation is negative, is where you see more market volatility. We do not foresee there to be significant increases in inflation, at the pace of inflation, above 6%. So again, we should see a positive reaction by equities and bonds alike. Now, can those two key contributors drive the market going into the second half of this year? We feel positive about it, but we'll continue to keep a sharp eye on it. Two other items that we're going to keep watching out for. The first one is the labor market. Jobless claims, or people filing for unemployment, had been increasing over May and June. Now, over the past 2-3 weeks in July, that number's actually ticked down a bit, which is a positive, overall for the economy. Labor market still remains solid. But another item is the quits. People quitting their job has been decreasing over the past couple months. That tells us that people are not as positive or as confident that they could get another job if they were to quit their existing job. Okay. The second item that we're going to keep a sharp eye on is this COVID student debt relief or forbearance. So over the past 3 years, students with federal student loan debt have not been accruing interest. Okay, the government has put a pause on interest accrual for those. Well, September 1st, that interest begins to accrue again with payments beginning back again on October 1st. What that tells us is, okay, there's going to be less people spending money now that they have to pay for their student debts and all the interest that's accruing with that. Between the labor markets, even if we see unemployment numbers increase again, as well as the student debt relief going away, those are deflationary factors. Okay, people are going to be spending less money in a sense, or people are going to have less jobs, less wage growth, and again, those are deflationary factors, making it easier for the Federal Reserve to get back down to that 2% number. They're not going to have to be as aggressive going forward with their interest rate hikes. Okay, so we have to remember that the economy is not the market, and the market isn't the economy. The market serves as a predictor of the economy. Where is the economy going to be at 12 months from now, 18 months from now? And right now, the market is still pricing in a mild recession. Okay, we don't think it's going to be a deep recession like a lot of prognosticators were saying 6 months ago. It's going to be a mild recession since the Federal Reserve seems to be getting in control of inflation, as we just discussed. At the end of the day, we need to keep in mind that it's impossible to time the market. Okay, don't try to time the market. Have time in the market, as we've all heard. We're going to show a chart here in a second, and really what it depicts is what does it mean if you were to miss some of the best days in the market. Okay, so over the past 20 years, if you had $10,000 invested in the markets, what number does that grow to? If you were fully invested the entire time, what happens if you miss the 10 best days of the market? What happens if you miss the 20 best days? So on and so forth. And the numbers are significant. Okay, so typically the best market days come right after some of the worst days. So that's why it's difficult to, okay, hey, I'm going to be in the market, now let's get back out. So it's better to be invested in a well-diversified portfolio, an actively managed portfolio for the entire, for your entire time horizon, rather than trying to time the market in and out. Because like I said, it's near impossible. So remain fully invested in a well-diversified, actively managed profile is the best way to combat volatility. Okay, but as always, we're here to help. We're here to answer any questions that you guys have. That's our job. We're happy to reevaluate account allocation, risk tolerance, objectives for the account, your goals. Just please feel free to reach out to us. We hope everybody enjoys the rest of their summer, and looking forward to a great second half of the year with everybody. Thanks again.